So I want to talk about DCA or lump sum. And you mentioned that point, and I think that is probably the most popular question because we're always conditioned to say dollar cost average is the best way for investing, and we should always do that. However, your research has shown something different.
Yeah, exactly. So this is a question that we get a lot, as you mentioned, and I would say I think I haven't checked the stats recently, but up until a few weeks ago, the DCA calculator that we have in our website, it was the most used tool that we have on the website. And let's start by kind of like talking about what is DCA, right, and what we mean by DCA. So imagine you have $100 in your bank account, and you have to make a decision. I'm going to deploy this to Bitcoin. You decided you want to buy Bitcoin with those $100, right? Are you going to deploy $100 today, or you're going to deploy $100 with some time? So let's say you may decide that for the next 10 months you're going to deploy $10, right? That's DCA, your dollar cost averaging a long time. I think people confuse a little bit, and that's why the definition is important, with somebody, for example, that receives a paycheck every 2 weeks, and then they get from their paycheck and then buy Bitcoin with their paychecks. Let's say they determine that, every paycheck I'm going to have $100 available that I'm going to go out and buy Bitcoin. This is not DCA. You're getting an average cost basis, right? But you're not dollar cost averaging, because I think the way that, and again, this is definition, the way we think about DCA is you have the capital available today, it's in your bank account, and you have to make a decision. What I'm going to do with this capital? Am I going to deploy it all now, or I'm going to deploy with time, right? That person that is receiving the paycheck and deploying, the capital wasn't available in the past, right? And neither in the future. They deploy the capital, right? So this is, for me, a series of lump sums. You're buying every 2 weeks a lump sum of Bitcoin. So now that we set a definition, let's look at the data, right? So we ran the numbers. I have to say, I think since 2011 as well, because that's where we have data. And what we did is that we ran a series of strategies. So the first one, for example, might have been, okay, so let's say an investor does for 1 year, they're buying every single day for 1 year. And then we run that for every single period of time until today, right? So you have massive amount of data when you do that, because I have all these different periods, right? And the average here is that let me tell what the results are. The results are an average, and the average is very dangerous. The average, in this case, is like the same thing as you put your feet in the refrigerator, your head in the oven, and you're gonna say, on average, my temperature is fine, right? You're gonna freeze and you're gonna cook, but on average, everything is fine, right? So on average, with that disclaimer, on average, lump sum beats DCA, which is counterintuitive, right? So you think, okay, if somebody deploying the capital right away, it's better than DCA. And when I ran this, I ran together with Sam Callahan, right? And we kept going back and forth. And Sam's like, I'm not convinced, why is that the case? I don't think, and I show him the data, and he's like, yeah, the data is correct, but it's counterintuitive. Why is that? And then we start digging into the scenarios and the periods. And one of the things that we saw very quickly is that, which kind of new, right? But then it becomes, I think, very obvious when you do this analysis, is that Bitcoin, the price of Bitcoin, and everything I'm saying is the past, right? It can change in the future, but in the past of Bitcoin, the price of Bitcoin has been most of the time sideways or going down, right? The periods where it goes up in very short periods of time, very concentrated, and in quick bursts, right? So it goes up very quickly. It's the opposite of a traditional asset, right? In equities, for example, people have a saying. They say, yeah, you go up the escalator and then down the elevator shafts, right? Bitcoin is the opposite. You go up with a rocket and you come down with a parachute, right? So you have these periods where price just skyrockets up, and then, periods of strength. And by the way, this is one of the reasons why hodling Bitcoin is so hard, because you have, days of glory and pleasure, and then you have months and years of pain, right? Where the price, just like now, price seems to be stuck there between 30 and 31,000. It's not going anywhere, right? And this is the norm. Most of the time, this is what we feel. But why I'm telling you this, because when you're doing DCA, you increase the probability of missing these updates significantly. So you may have your DCA and price is going down, so that's good. But when it goes down slowly, right? So you are getting better prices, and then all of the sudden you miss this massive move up. You're never going to catch up again because now you're back DCing at a much higher level, right? Than you were before. There's some analytics on the site as well. We actually got like the top, and you can customize this, but I think the default, it will show you like the top 10 3-day moves of Bitcoin since 2011. And when you look at these periods, like it's massive return. So by just missing these periods in every, like the top 3 days in every year, you're already like, instead of having a positive return, having a return is very close to flat, right? So it's a very asymmetric risk return profile in that sense. So as I said, on average, if you look at the DCA versus lump sum, you're better off doing a lump sum.